morning.
James, good morning.
It's good to see you.
Good to see you as well. Thank you.
Looking back in July, you still got the mustache.
July? My gosh, the summer is flying by, and I hope everyone who's tuning in today has been enjoying it.
Yeah, I know I have been, but it is come and gone.
Gosh, yes, it certainly has. So through July already, what in the world did it bring to the markets and portfolios?
Well, we can start with the market update if we want to.
Let's jump in.
But thanks for joining us.
Yeah, absolutely. So the month of July actually was a good month, and we saw a 3.2% increase in the S&P 500. So these are going to be the top 500 companies here in the U.S. Probably the best gauge from our perspective of like, what did the broad equity market do? Just because within those 500 companies, you've got things that are growth oriented versus value oriented. So it's just a nice wide scope. So 3.2% to the upside. Here's a detail I want everyone to take away though. The Dow, which is just 30 large industrial stocks, Dow Jones Industrial, actually had a 3.4% gain. So what you have typically seen this year is growth, or those, the NASDAQ type stocks really leading the charge, and then S&P too. But now you're starting to get this buy-in, and we touched it last month about the broadening out and more participation on the move to the upside. And quite frankly, that's what we need to see for this move higher to be durable.
And it started to occur.
It started to occur. So again, to see that those 30 large, the Dow Jones Industrial is more of a value ilk. Maybe it's a sleepier type of stock. Maybe it's a more mature company, pays a dividend, stuff like that. But everybody's got to be moving in the same direction for the move to be durable. So that was good. Bonds, unfortunately, did not have as much prosperity in the month of July. We saw the aggregate bond index, which is just a basket of bonds, flat. It was actually down 0.07, but we can call it flat. Right. We saw some pickup in interest rate volatility, and we had touched last month that we saw that subsiding. Well, the Fed decided that they wanted to change that a little. Yeah. So anyway, again, it was rather flat month for bonds.
All right. Yeah. Well, and we also touched in June kind of some of the earnings that were going to be, coming to an end or, wrapping up that earnings season, at least that swath of it. So how did that turn out?
Yeah, you closed the quarter and quite frankly, half the year at the end of June. And then what you get are companies reporting and saying how they did in that 3-month quarter. And then they'll typically give some guidance going forward. And right now where we're at, investors seem to be more focused on the guidance because through the month of July, we got about half the S&P 500's earnings reports. They weren't great. We actually saw softish numbers. Probably you have to go back to 2020 to kind of see some of the revenue decline that we saw in the S&P 500, somewhere around 7% to the downside. But the guidance that corporate America gave was really what was able to propel stocks higher. So imagine if I report to you what happened in the rear view, but say, but this is working out really well for us, and the stock market is called a discounting mechanism. Quite frankly, it's looking at 6 to 12 months into the future. So, of course, the market's going to want to know not what's already happened, but what do we anticipate. So I guess we can say not a tremendous earnings season, but the guidance given looks more robust, perhaps, than was anticipated. But, we'll see what the latter half of the S&P has to say.
And for the rest of the year.
Yeah. But all in all, not a train wreck.
Yeah. Well, and that's good considering, the year that we were coming out of.
Yeah. and avoiding train wrecks has been pretty substantial here because earnings train wrecks, economic train wrecks, it's all been holding up pretty darn well. Yeah. And then with this broadening out, it's okay to be a little bit optimistic about where we're at.
And we've been optimistic about stocks and, the economy and kind of looking at different things. I think something that we've been touching on for a couple of years, we used to joke that it was a sponsor of the podcast, which was inflation. But if we're looking at some new words maybe that we're hearing more often, but not to us, is really kind of deflation versus disinflation.
Yeah.
Right?
Yeah.
What is the difference between that?
I thought Jay Powell was the sponsor of our podcast.
Right there.
Inflation, same thing, one and the same. Yeah, so they're two D words.
Yeah.
And they both kind of touch that inflation word too. But yeah, so disinflation is where the rate of inflation slows down, but you still have positive price movement.
Okay.
Deflation is when the price of things are dropping. So right now, one of the words that the market was very excited to hear Jay Powell utter was disinflation. And that's a lot better, again, than deflation is a problem in and of itself.
Right.
You try to kind of avoid that. Now, when you think about what our Fed's dual mandate is, quite frankly, the Fed exists to promote two objectives: full employment and price stability. Full employment, you kind of get that. But let's talk about that price stability. That's truly the inflation control, inflation targeting. Right now, they want a positive rate of inflation, but they want it at 2% year over year. And where we're hovering, we're at about 3%. So they want it to be down. But did you notice that they don't want a -2 print? Because that would be deflation. And that, again, is a problem. That's almost a bigger problem to solve than controlling inflation. So you want to try and avoid that deflation. But disinflation is truly the target. And when you look around, I think that the market is definitely acknowledging that perhaps that is what we have. Perhaps we have disinflation, and we have it with a robust jobs market. When you look at the consumer, consumer confidence is high. So some of these things would really support that soft landing camp, no landing camp. But, again, you can't drop into that deflation because that gets scary too.
Right.
So that's usually when the Fed does too much. They're trying to dial things in with their monetary policy to just slow down that rate of increase.
Right.
So that's where we're at. But when you hear the two, there is a distinct difference
between the two. So we've felt this market move up. Yeah. We see it on our statements. We see it in our reports that maybe we give to our clients. Yeah. We hear it on the news. But where's it coming from? We talk about earnings, we touch on inflation, but if we look at technical versus fundamentals in this market, I guess first, Ryan, what's the difference between technical and fundamental?
Yeah.
And then go from there.
Yeah, so we're going to build out another difference. When it comes to now, why am I buying a stock?
Right.
And really, when you buy a stock, what are you buying? You're buying ownership in a company. Stocks are called equities because they represent ownership. Think of the equity in your house. It's the way that I would describe how much of your house do you own. Stocks are referred to as equities because they're ownership in business stakes. Okay, well then now we're on to something. So if I'm going to go buy a business stake, I probably should understand relative to its productivity, how much should I pay for it? So if I always like the example of a gas station, because we all have them around our neighborhoods and what have you. So if you walk into a gas station and say, I'd like to buy the place, the owner is going to say, how much are you willing to offer? Well, your next question should probably be, well, how profitable is this place? If you're wildly profitable, I'll give you a high offer to buy this place. But if you're barely breaking even, I'll probably pay you just for the real estate. That's a fundamental decision-making process. The fundamental reason that you're going to offer a price is because of the earnings.
Because of what you're seeing.
There you go. No. So in the market, we can do that. We can do that with what's called a price to earnings multiple. And oftentimes you're looking at forward earnings. Remember, I'm going back to the S&P 500's earnings reports. Everybody's looking at down the road. Well, okay, fine. Let's look at the forward price to earnings multiple. That's a fundamental decision as to why you would buy a stock. Now, you can take and totally change gears and say, I don't care. I'm just looking at a chart here. And technical analysis would lead me to see that we're well below the 50-day moving average, the 200-day moving average, and I see a big gap in the chart up here in this price movement. And I can see that the RSI is, very, very low, relatively speaking. I'm going to buy that position just because the chart kind of tells me
based on the numbers of a broader view, maybe?
Technical analysis. Okay. Now, it's this whole idea of I'm not really looking at the fundamentals. I'm just looking at the technicals.
Okay.
Now, there are people out there that have an entire career where they don't ever look at a fundamental. They're just looking at the technicals. And their theory is that the fundamentals are in the technicals. The chart doesn't lie. The chart says everything. Maybe. But to think that we see just phenomenal value from a fundamental perspective in the market, you're going to really have to argue that case for me. Not saying that means that there's something broken here,
right.
But truly it's like buying the kid bigger shoes to have him grow into them.
Yeah.
I mean, and that kid's feet better grow. It's a fundamental side. Technical side, my goodness, we were so negative coming into the year. It just technically driven market analysis would say you're probably due for a good bounce.
So then if we take a step back,
Mm-hmm.
we look at those two different parts of the market or views or research, what do we think's driving the market so far?
Yeah, well, it's got to be a little bit of both because it always is. But I would just say that the pain trade has been to the upside. I don't want to pour cold water on this market move because, truly, it could keep going, and this could be something, honestly, what nobody's looking for is oftentimes what happens.
Yeah.
The market exists to make the most amount of people feel silly.
Yeah.
But when you truly peel back the layers of the onion and say, okay, is this stock a tremendous fundamental value? It's really hard to state that case. There are parts of the market. So for instance, look at the S&P 500. It's got, and this would be as of today, basically, 19.6 times forward earnings. So we're paying 19.6 times next year's earnings on the S&P 500. Historically speaking, that would be rich. But then if you say, okay, but what about some of the components of the S&P 500? Maybe you would want to do an equal weight S&P 500 and go more towards the smaller companies. All of a sudden, that forward PE goes down. So there are parts of the market that offer a little bit of fundamental value there. But we just want to be careful.
Right.
And when you see interest rates elevated, so keep your eye on the 10-year breaking above 4%. When the interest rate on the 10-year Treasury bond goes above 4%, it's really hard to pay that type of premium.
Looking ahead.
And why is that? Because somebody goes, well, my goodness, I could just park my money here and be well compensated.
Yeah.
So anyway, I'll stop there because I can keep going.
But that actually goes into kind of our next topic. So we're looking at all of these
Right.
parts.
Oh, yeah.
And that gets into the portfolio construction that we're looking at all the time.
Yeah, yeah. So, and the Bruce Lee saying is you've got to be like water. Right. You have to be like water when it comes to building portfolios. You have to have an open mind. You cannot be so convicted that you're not willing to listen to other alternatives. And that's what's so critical right here. So I'll give you, for instance, what do we do in this environment where it doesn't seem like there's tremendous fundamental value out there? Seems like there's, a lot of individuals willing to take a risk and things like that. What you have to watch for is momentum. And you have to watch for those technicals. Because if there's some blue sky below because there's not tremendous fundamental support, you've really got to make sure that momentum is being tracked in the market. And so, as you know, we run a weekly screen and then we break that down to daily screens on the different components of portfolios. And then our job is to be so open-minded and so focused on opportunity. And opportunity isn't always making money. It's just not taking silly risks.
Yes, unnecessary.
Right, and taking the right risks.
Getting paid properly for those risks.
Bingo. So that's really how you've got to be so focused on being willing to adapt in this environment. Willing to adapt is what your portfolio needs to be constructed on right now. And what are we doing?
We're there.
We're willing to adapt.
So, well, Ryan, as we look ahead,
Yeah.
Looking at numbers, the Fed, JPA, all these different factors, what are we thinking about for August?
Yeah, for the month of August.
looking at August
Yeah.
before.
Well, okay, so in the summer months, you tend to have less volume in the markets. So what that means is I just said that when you buy a stock, you own a business, right?
Yeah.
Well, the stock market's just a big auction for those businesses you own. Well, imagine if you had an auction and 2 people showed up to your auction. Well, okay, fine. But imagine if 10,000 people showed up to your auction. You're going to have a much more efficient price discovery mechanism to really get to the bottom of what, fundamentally speaking, where should this market perhaps
Things are
be?
worth.
So in the summer months, you tend to find volume dry up. Why? Because everybody wants to go and take their vacations, things like that. But once you start, August will start to drive a little bit more of that volume pickup, certainly after Labor Day and so on and so forth. So I do see some of the things that are driving this market starting to come more into focus through the month of August. You might experience a little bit more volatility pickup in that environment. As things have been meandering through the summer, you're going to start to get a little bit more pickup there. So what do I think looking ahead that we're going to encounter in the month of August and probably September? Just more volatility, more volatility. So buckle up, enjoy the fact that we've seen a breathe higher.
Yeah.
I think if anybody out there ever questioned whether the market could go back up, this is your answer. You know, oftentimes history looks rather similar.
Yeah.
You know, think about this. If I told you we bought something today for $100 and 2 years from now we could sell it for 101, not the most tremendous return or anything, but, you know, somebody'd do pretty well if they hung on to that.
Yeah.
But what if I then told you, yeah, but it dropped to $70 in between those 2 years? Well, now I really need to know, what did you do?
Mm-hmm.
What did your emotions drive you to do? What did you do? Because that matters so much, and you have to focus on that long term. So we'll buckle up for any volatility. This is the environment that you would catch it in.
Yeah.
And we'll be back to report in August, sir.
Be on top of it in between. Thanks for joining us. Thank you for joining us, and we look forward to seeing you next month.